In January 2026, every analyst on Wall Street agreed on one thing. Palantir was finished. The stock had collapsed. The headlines were brutal, and I was quietly buying as much as I could. That position returned 2,300% in 3 years. Not because I had insider information, not because I got lucky, because I was applying a framework that the market consistently ignores. And right now, that same framework is pointing at 8 specific companies sitting in the most structurally protected positions in the entire AI economy. If that interests you, hit like so this reaches people who actually need to hear it. What I'm about to walk you through took me years to learn how to see. Here is the mistake almost every retail investor is making about AI right now. They are watching the applications, the chatbots, the consumer-facing products, the visible, exciting, headline-generating surface of what's happening. And that is precisely the wrong place to look. Because the application layer of every technology transition in history has been a war zone. Intense competition, rapid commoditization, uncertain monetization. Most participants lose, a few win big, but nobody can tell you in advance which ones. The companies that built generational wealth during the California gold rush of 1849 were not the prospectors. Tens of thousands of men flooded the Sierra Nevada with pickaxes and ambition. Most of them went broke. The people who compounded real wealth were the ones selling picks, shovels, food, and shelter to every single miner, regardless of whether they found gold. Levi Strauss built a durable goods empire. Wells Fargo built a financial institution that still exists today. They did not bet on who would strike gold. They bet on the infrastructure that every gold seeker needed to function. That distinction is everything, and it is the exact lens I am applying to AI right now. Think about that for a second and drop a comment below. Are you investing in the gold rush or the picks and shovels? I read every single one. The AI economy runs on 8 distinct infrastructure layers. 8 layers that every AI company, every enterprise deploying AI, every research institution training models must use. These are not optional. They are the physical and digital substrate that the entire industry runs on. And the companies controlling them are operating with competitive positions that range from near monopoly to actual monopoly. Let me take you through each one. The first is physical infrastructure. The data centers, cloud platforms, and computing environments that house everything else. These are the landlords of the AI economy. They own the land. They collect rent from every single participant regardless of who wins the AI application wars above them. Google Cloud is growing at 63% annually. Microsoft Azure at 40%. AWS at 30%, from the largest revenue base in cloud history, with operating margins now at 40%, up from 29% just 3 years ago. Every additional dollar of revenue they earn costs less to generate than the one before it because the fixed infrastructure is already in place. Oracle sits in a specific and chronically underestimated position here. Its existing enterprise clients, the largest organizations in the world, represent the largest remaining migration opportunity in the entire cloud market. Those relationships were built over decades. They are not easily disrupted. The second layer is compute, the actual engines. Every AI data center requires 2 specific components to function: graphics processing units and high bandwidth memory. Without them, nothing runs. And here is where the competitive dynamics become genuinely extraordinary. NVIDIA's position in AI-grade GPUs is the most durable moat in the entire infrastructure stack. The CUDA software ecosystem, the programming environment that allows developers to optimize code for NVIDIA hardware, has been under development for 15 years. Moving to a competitor's hardware does not just mean buying different chips. It means re-engineering millions of lines of code that developers have spent years optimizing. That switching cost is not theoretical. It is measured in hundreds of millions of dollars and multi-year timelines. NVIDIA is currently trading at approximately 24 times forward earnings, for a company whose earnings are growing faster than its stock price. ASML manufactures the extreme ultraviolet lithography machines that produce the world's most advanced semiconductors. The physics of EUV lithography, using light with a 13-nanometer wavelength to etch circuits at atomic scale, required decades of scientific development that no competitor has come close to replicating. ASML is a monopoly in the literal sense. There is no second source. Every advanced chipmaker on Earth, TSMC, Samsung, Intel, must purchase from ASML or fall behind the technology frontier permanently. TSMC itself sits in a similarly protected position. The process technology for producing chips at 3-nanometer and 2-nanometer nodes is so concentrated at TSMC that replicating it would require a decade of capital investment and process development. The mode is not just technical, it is temporal, and Micron supplies the high-bandwidth memory that AI chips require for parallel, data-intensive neural network workloads, an oligopoly market with capital barriers so high that new entrants are effectively locked out. Now here is where it gets interesting, and where most analysts stop paying attention. The third layer is networking. Inside every AI data center, thousands of servers must communicate with each other at microsecond latency and extreme bandwidth. The company that has built the dominant position in this specific function is Arista Networks. Its EOS operating system is so deeply embedded in data center operations that replacing it requires re-engineering network architectures, retraining entire operations teams, and accepting a period of genuine operational risk. That switching cost is not a preference, it is a structural lock. Arista runs at 43% operating margins, carries zero debt, holds $11 billion in cash, generates $4.5 billion in annual free cash flow, and is growing revenues at 30% annually. Those numbers are not the profile of a company under competitive pressure. They are the profile of a company collecting rent. The fourth layer is the one I believe is most radically underestimated. And when I tell you what the physical constraint is, I think you'll understand why. High-density GPU clusters, the specific configurations required for large-scale AI training, generate heat at power densities that traditional air cooling systems physically cannot manage. This is not a preference problem or an efficiency problem. It is a physics problem. The industry is being forced to transition to liquid cooling systems, and the transition is not optional. It is driven by the laws of thermodynamics. Vertiv Holdings is the dominant supplier of liquid cooling for high-density data centers. Its backlog, the contracted, committed, scheduled work already sitting on its books, represents years of guaranteed revenue from hyperscale operators who have already signed. This is not speculative demand. It is already sold. Constellation Energy addresses the other dimension of the same constraint, power. AI data centers require 24-hour, weather-independent, scalable baseload power. Renewable energy cannot provide baseload reliability. Nuclear can. Constellation is the largest nuclear plant operator in the United States, and it is signing decade-long power purchase agreements with the largest balance sheets in the corporate world. Bloom Energy covers operators who cannot wait for grid connections, on-site fuel cell systems that generate power adjacent to the data center, bypassing the grid entirely. The deals being signed right now reflect how acute the urgency has become. Share this with someone who thinks AI investing just means buying the most talked-about stock. What I'm describing here is the layer underneath that, the part that doesn't make headlines but captures the most durable returns. The fifth layer is where Palantir lives. And I want to explain precisely why its position is the least intuitive and most misunderstood of all 8. Enterprise AI deployment is not primarily a technical problem. It is an operational problem. The challenge is not building a model that can perform a task. The challenge is integrating that model into existing enterprise data systems, regulatory requirements, compliance frameworks, and organizational workflows in a way that produces reliable, auditable, and accountable results. Palantir spent 20 years building exactly that. The data integration pipelines, the workflow automation, the governance architecture required to deploy AI in environments where a mistake cannot be explained away. That investment cannot be quickly replicated. A competitor building a new enterprise software product today is not competing against Palantir's current product. They are competing against 20 years of accumulated implementation experience and customer trust. The stock is down from its recent high. That is the same pattern that accompanied every significant correction in its history. And every time investors sold at those corrections, the business's fundamental earnings trajectory proved them wrong. The sixth layer is data, the fuel. AI models are only as capable as the data they access. MongoDB's document-oriented architecture is specifically suited to the unstructured and semi-structured data that AI applications consume. Oracle's enterprise client base represents the largest remaining migration of legacy data infrastructure to cloud-native systems happening anywhere in the corporate world. The seventh layer is observability. Datadog is the monitoring standard for cloud-native environments. The switching costs in monitoring software are among the highest in enterprise technology. Replacing a monitoring system requires re-instrumenting every application in the stack and accepting a period of reduced operational visibility. That cost is prohibitive for most enterprises. The loyalty it creates is structural, not preferential. The eighth layer is security. Every AI deployment expands the attack surface of every organization that uses it. CrowdStrike provides AI-driven endpoint security across individual devices and workloads. Scalar controls access security, ensuring only authorized users and systems can reach sensitive AI infrastructure regardless of physical location. Their competitive positions deepen with every expansion of the AI infrastructure they protect. Now I want to make the most important analytical point of everything I have said. Every single company I have named shares one specific characteristic. Their revenues are not contingent on which AI application wins. NVIDIA does not care whether OpenAI or Google produces the dominant language model. ASML does not care which hyperscaler builds the most capacity. Arista does not care which enterprise software vendor captures the most AI revenue. Vertiv does not care which data center operator grows fastest. They are the picks, the shovels, the dynamite, the supply chains of the gold rush. Their revenues grow with the build-out, not with the outcomes of competitive battles they are not participating in. That is a fundamentally different risk profile from betting on which AI application survives the next 5 years. It is the structural necessity play, not the competitive bet. The capital committed to this build-out makes the thesis durable in ways that cannot be reversed on a short-time horizon. The major hyperscalers have committed hundreds of billions of dollars annually to AI infrastructure capital expenditure, structured as multi-year contracts already in execution. The U.S. government has committed over $1 trillion to grid modernization. Fortune 500 companies across every industry are committing multi-year budgets to AI deployment. That capital flows through the 8 infrastructure layers I have described regardless of which applications win. Many investors look at the appreciation in these companies. Arista up over 300% since we identified the thesis. NVIDIA up over 300% since the position was opened. Vertiv up over 200% in under a year. And conclude they have arrived too late. I want to address that directly. An investor who looked at Amazon in 2010, after it had already appreciated substantially from its post-dot-com lows, and concluded the cloud opportunity was closed, would have missed the decade that dwarfed everything that came before it. The AI infrastructure build-out is in its early stages. The capital commitments are front-loaded. The infrastructure is being built now. The revenues that will flow through these companies will compound for years beyond the current build-out phase as the operational AI economy, training, inference, enterprise deployment, application development grows on top of the base being laid today. The Palantir thesis was not about a stock that had not moved yet. It was about a business whose fundamental value was being dramatically mispriced by a market focused on near-term losses rather than structural positioning. The same principle applies to every layer I have described. The market is pricing these companies for today's earnings. The thesis is about what those earnings look like in 5 years. When the build-out has matured, when the operational AI economy is running on the infrastructure being constructed right now, and when the moats that exist today have been compounded by another half-decade of customer relationships, switching costs, and engineering investment. I have been doing this long enough to know that the investors who act on structural frameworks rather than price momentum are the ones who capture the returns that feel obvious in retrospect and invisible in the present. Palantir was visible in the data in January 2023. The difficulty was not finding the thesis. It was acting on it while everyone around you was calling it wrong. The data is visible now. The question is whether you can act on it before it becomes obvious. If you want a daily breakdown of the specific numbers, contracts, and earnings signals I monitor across each of these 8 layers, every single day, subscribe. I cover this every day, in depth, in a way you are not going to find anywhere else. And if this video shifted how you think about where the real AI money is being made, share it with one person. It takes 3 seconds and it might save them from making the wrong bet at exactly the wrong time.